If there's one thing that messes with people's heads when it comes to their finances, you can be sure to bet that it's going to be their loans. And the truth is, for most people, there's no real way to avoid them, because one way or another, you're probably going to need to take out a loan at some point in your life, whether that's for something like a mortgage or maybe a car loan. And I don't think people quite realise how much an impact it makes on them, especially when they get to see the total amount of interest that they've been paying.
And it's gone.
As such, there's a common question that ends up coming up when people end up getting a bit more disposable income to their name, and they wonder to themselves, is it best to use that new income and start paying down them loans that they have? Or maybe it might just be better in the long run to stick it into a savings account and leave it there instead. And look, I get it. This is one of those questions that can really stick in a person's mind. It can have them pondering all hours throughout the day. Maybe even if they're so inclined, get the spreadsheets up and running to see if they can work out what is the right path, at least monetarily, for them. But this question does have its caveats, because it's not just a simple matter of what's going to get you more money over a period of time. I would like it to be that simple, but like most things in life, it isn't. This conundrum, it's enough to make most people go mad. And it's difficult for videos like this to help, as from person to person, the answer is rarely ever going to be the same. So with that in mind, I'm going to go through this exact situation in this video using real examples, real numbers, and real calculations, so that you can get a better understanding of what you should be looking for in your own decision, and hopefully so you yourself know what you need to decide. With this situation, I'm going to run through 3 scenarios, 2 of which you probably know about, but the other one I call the Seesaw Method. And hopefully by the end of the 3 scenarios, you'll understand what might best fit your life. But first, before we jump into the example, my name's Ross. I'm a level 4 diploma holder in regulated financial planning. On this channel, we're just trying to help make sure that you understand what you're doing when it comes to your financial decisions in your life. With that, let's get right into setting up the parameters for this example. So for these scenarios, we're going to go ahead and use mortgage payments for it. Now, this could also include car loans if you wanted to. Obviously, the interest rates will be a wee bit different, but as they're both amortizing loans, which I'll explain what that means later in the video, the logic will apply the same to both. So even though it's a mortgage payment, if you tweak the numbers a bit, you can apply it to your car loans as well. And so you can play about with it yourself. I've left links down below to the websites I used for some of the simpler calculations, so that by the end of the video, when you know what you're doing, you're able to go in, have a play about, and see what might be best for you. Or if you're bored, you can just look at the big numbers, which I mean, I would never discourage. I quite like that. So to start us off, let's say you've got your first mortgage. It's a 25-year term mortgage you managed to get for your house. And let's say the mortgage value is 200,000. And for the interest rate on this mortgage, we're going to go ahead and put about 5%, which is maybe not exactly that average, but it's a fair enough one that will be close enough to most people. And again, if you're watching this in some other time and mortgages are completely different, or again for car loans, which are normally a bit higher, then you can, in your own calculations, just change this number, but the logic will still follow through. So with these factors, your monthly payment that's going towards interest and the principal is going to end up being 1,170 roughly. And of course, this is just the mortgage payment itself. This has nothing to do with council taxes, insurance, anything like that. This is strictly what you're paying the bank back for your loan. So now that we've got the terms of the loan laid out, let's say a year later, you've gotten a big pay bump at work. You know, you've been putting in the overtime, making that real shareholder value. And now you've got an extra £500 a month that you're willing to spend, and wondering whether you should start tackling this mortgage, or if maybe there's a better thing you should be doing with it. And with that, we come to the crux of the video. With this extra after-tax £500, are you going to either put it more into the mortgage to pay down the debt quicker, or are you going to instead take it and invest it into a savings account over the remainder term of that mortgage? So for the remaining 24 years, would you be better putting it into a savings account and investing it? When it comes to putting it into savings, let's assume that that's going into a low-cost, globally diversified index fund, just to keep the examples nice and straightforward and easily applicable to most people. Let's also say that that savings account that's being paid into is a stocks and shares ISA. That'll make it so stuff like capital gains and income tax, when it's being taken back out later, doesn't need to be taken into consideration. Obviously, if this isn't available to you, then you'll need to bear that in mind in these calculations. But for the sake of this example, we're not going to have a need to take into account stuff like them taxes. So with that, let's start with the investing scenario. So let's say on month 13, you start investing that extra £500 a month into a stocks and shares ISA, and you continue to do that every month. Let's also add in another parameter that maybe make it more realistic for a life scenario, as your income's likely to rise over your career. So let's say every year at the start of the new year, the contributions increase by 3%. So that means the £500 would increase by 3% after 12 months of investing, and that will continue for the remaining 24 years. And then for the expected returns, we'll go ahead and say that it's going to be 7% per year, as this is in line with historical averages, and it's also taken into account inflation. So this should retain your buying power over the long term and keeps it consistent for the comparisons. So with the parameters of over 24 years, you're investing £500 a month, and every year that £500 a month increases by 3%, an expected return of 7% per year, that grows to approximately £490,000 by the end of the 24 years. Now obviously, that's a serious amount of money, nothing to scoff at, and that's going to get you some real financial flexibility and definitely a degree of freedom when it comes to that stuff, as it's in a stocks and shares ISA as well, so there's no tax going to be due on that as well. That is money to spend at your leisure and can be something, for example, like a bridge to retirement that might let you retire early without needing to access your pensions. So the scenario one of just investing has set a pretty high bar, but now we'll look at the other scenario people consider, and that's paying down the mortgage with the extra money a month instead. Before we go into the specific numbers of the scenario, I just want to quickly explain how mortgage loans and car loans work as well. They work through a system called amortisation. For those that don't know, when you're putting your money towards your mortgage or your car loan, at the start of that loan, you might think that most of that money is going towards paying down the debt, or at least half of it's going towards paying down the debt. But in reality, that's not the case. Using our current example, in year one of that mortgage, you're going to pay about roughly £14,000 towards your mortgage. Of that £14,000, only £4,000 of it is going towards actually paying down the mortgage. £10,000 of it is just in interest. And for the remainder of the term, I'm going to put a table up here so that you can see how this proportion changes over time. So basically, as the loan goes on and on and more begins to go towards the actual principal of the loan, and less goes towards the interest payment. And as you can see from the table, even in year 11, over half of the mortgage payments that you're making are going towards the interest payment and not to the principal. And that's why banks are very happy to give out these loans, as this system, it does make them a lot of money. Now with amortisation cleared up, we're now going to move on to the scenario of paying down the mortgage instead of investing it. So in line with the previous example, starting on month 13 after your pay bump, you're going to start putting £500 a month into paying down this loan early. And again, in line with the previous example, every year that £500 payment, that's going to increase by 3%. Now, obviously, when it comes to early repayments on mortgages, normally that varies from provider to provider. Some of them might let you do monthly repayments. I've seen other ones that are, you've only got 1 month a year that you can make repayments. So again, these things can be factored into your own calculations, but just for this example, we're going to assume monthly repayments. So what happens if you end up doing this? Well, what actually happens is that you end up having your mortgage fully paid off in about 13 and a half years. So you're ended up cutting off 11 and a half years of mortgage payments from a result of doing these early repayments. That drops your total interest paid from what would normally be £151,000 to about £80,000. Obviously, that's a fair chunk of change that you're saving in interest payments. An important thing to bear in mind with this though, is that while you've saved about £70,000 in interest payments, that saving didn't just come out of nowhere. The fact is, you made extra repayments to be able to get this saving. So while you're saving £70,000, you've also spent the amount of repayments over the term as well. So it's not just a strict £70,000 saving. In fact, over those 13 years of repayments, you ended up spending a total of £89,000 towards paying down your mortgage early. And so with that in mind, you actually end up making a net loss of £18,000 when you bear in mind the interest saved and the amount spent on extra repayments in this example. Now, obviously this doesn't sound ideal. No one wants to just lose £18,000, and there's not many people that would lose that and then call it a good thing. But there's some things to bear in mind with this, in that there's no volatility at all attached to it, whereas investing there will be elements of that over the term of the investment. And then things like sequencing risk, such as timing when you're saving. And then things like no taxes need to be considered as well. Obviously in that example we used ISAs into the investing, so taxes wouldn't normally need to be considered, but if that isn't an option for you, then taxes would be something that has to be considered. Whereas there's no scenario where taxes need to be considered when you're overpaying your mortgage. But even with these advantages, a loss is still a loss, right? So clearly the investing scenario seems better here. But that's not exactly true, because there's still one thing that needs to be considered here. Once you've paid off the mortgage, it doesn't just stop, like the money you were putting towards it doesn't just disappear. You now have an extra large amount of income each month as you no longer have monthly mortgage payments to make. You now have your original monthly mortgage payments that you're making each month of £1,170 at your disposal. And in addition to that, you also have the £500 a month that you were also saving on top of that. And as that was growing at 3% per year, at the 13.5 year mark, that's now at £712 a month you're also getting back. So in total, you have just under £1,900 extra a month at your disposal. And so, to make the comparison fair, for the remaining 11.5 years, what would happen if you then started investing that into a savings account as well? So investing that extra £1,900 a month at a 7% return for the remaining 11.5 years, that's going to get you £460,000 by the end of the same term. So at the end of the 25 years of the mortgage. So you're going to have £460,000 in the savings account. But technically, if you bear in mind the interest that was lost, it's going to be about £440,000 for comparison's sake. And if you want to be really technical, I suppose, if it's £1,900 a month going into an ISA, that would max out your ISA allowance, especially if it's also growing, or the £500 element is growing 3% every year as well. So there technically would be a possibility of some taxes being due in that example as well. So do bear that in mind, but there is likely methodologies you could take around that to minimize or eliminate the taxes that would maybe be due. So with that, we can look at the final comparison of what's left in your savings pots. Investing only, you're going to have £490,000 there, and then prepaying your mortgage, you're going to have £460,000. So in this case, it still looks like investing does take the cake, but there is some important things to bear in mind, as obviously this example has specific rates and expected returns. And if you were to change them figures about, such as a lower expected return over the investment horizon, or something like a higher interest rate on the loan, then it could see itself flipped around, and it could end up being that paying down the mortgage is actually going to end up with more in the end. These things can chop and change, and that's why it's so difficult for any one answer to be the right way. The fact is, personal finance is, well, the key word is personal. Each person is going to have a different situation, and as such, it's really important that you do your own research and use your own scenario to make your own decisions. But with that, I alluded to a third scenario that you could maybe take instead of doing either investing or paying down the mortgage. And it's something I've somewhat dubbed the Seesaw Method. And if you couldn't already tell, it's instead of doing one or the other, why not just do both? This might sound a wee bit silly initially, but financial planners love their analogies, so bear with it because I think it does illustrate it quite well. So let's imagine a playground seesaw, and on the seesaw at each end you've got the you that's got a big investing pot saved because they put all the money into investing, and then on the other end you've got you who's repaid down his mortgage early, and as such, while he doesn't have as big a savings pot, he's had a lot less stress for a longer length of time because he's not had these loan repayments hanging over his head. So when you pick to either invest or pay down the mortgage, you're putting money towards one of these sides of the seesaw, and it pushes it down closer to the ground, closer to reality. But the thing is, for those who might have never sat on a seesaw, the goal isn't to just slam one person into the ground and send the other one flying. All that ends is someone being launched 10 feet into the air and flat on their back, or someone with a very sore arse because it's hit the ground way too hard. And so the goal with this method, like most things in life, is to take a middle path and take a balanced approach to the options available. Now with the Seesaw Method, that doesn't necessarily mean a split down the middle of 50-50. It could be split up 60-40, or even 70-30, or maybe it's 60-40 for a number of years, and then it switches around to be 40-60 for the remainder of the years. Examples of how you might change it: it might be age-based. So if you're much younger and you have a much longer investment horizon, it might make more sense to put more money into investing early, as you've got a longer investment horizon, even beyond the 25 years of the mortgage. The fact that that money is going to be invested for 40 years if you're only 20, versus if you're 40 and you pay down the mortgage and then you're going into retirement as well, so you're starting to draw out the savings. Another way on how you might want to balance the seesaw might be taking a rates-based approach to it. So at least if I was to do it personally, it would be, well, I think a loan, if it's over 6% interest, I would likely be putting a majority portion of paying down that loan. And then if the loan is under 3.5% interest or 3% interest, I'd likely be looking to invest more instead. And then if it's in between those two, well, I would split it up accordingly. But again, that's just what I'm comfortable doing. Each person to their own. It's not specific financial advice. So with this approach outlined, we're now going to see it in action, see the numbers using the previous examples. And for this case, we're just going to keep it simple, and we're going to say it's a 50-50 seesaw approach. So when you get to month 13, the £500 will be split in half. 250 will go towards paying down the mortgage quicker, and 250 will go into investing into a savings account. So doing this, it ends up making it so that your mortgage is paid off after 17 years in 1 month, or just under 8 years early. And then at the same time, when the mortgage is fully paid off, you're going to have about £121,000 saved in your savings account. So with this method, not only do you have a longer period of reduced stress, reduced anxiety, with lower bills coming in each month and just more disposable income and what you want to do with it, but you also have a nice nest egg available to you once the anxieties have gone away for you to do with what you want as a result. And as such, even though in this example in a second we're going to extrapolate it out to really be able to compare the three side by side, but in reality, this isn't what you need to do. If by the end of paying off the mortgage and you suddenly want to go on a big holiday to celebrate this stuff, because you now have, again, no mortgages to pay, you now have a nest egg that lets you instantly jump into that life. Obviously, again, each person to their own. If you'd rather just go straight back into saving, obviously that's what you're going to do. But the fact is, this option gives you more, well, options. So it's an important thing to take into account. But yeah, to continue to keep it in line with the examples, we'll now take the money that you were paying to both your mortgage and into your savings account, which totals about £1,970. We're now going to take that and invest it into the savings account as well, and do that for the remainder of the term. And again, if you've forgotten how we might have ended up with that number, we've got the regular mortgage payment of £1,170, and then we had the £500 that was increasing at 3% per year. And at this point, it's at about £810. So you're taking that, you're adding it on to the regular monthly payment for your mortgage, and then that's how you've got your new disposable income that's been freed up. And with that, before we get into the final examples in comparison, if you've enjoyed the video so far, please do like and subscribe. It really does help the channel out a lot. This video has had a lot of work put into it, as getting together all the figures, running out the numbers, putting the graphs and the tables all into present was a fair amount. So leaving a like, it really does show your support. And be sure to subscribe so that you don't miss any future videos that might be covering topics in finance that I can really help you with. But yeah, back to the seesaw results, running out the 50-50 method. By the end of the 25 years, you've got a savings total of just over £470,000 sat there for you. And now with all three scenarios, we can now go ahead and put together a table, put them all side by side so you can clearly see what results you're going to get from each one, so that you can take this into account yourself. And do bear in mind with these examples, if you change the expected return, if you change the interest rates, the amount that you're saving, which one might be on top will change. And this again shows why I really do like the seesaw method, as while it doesn't have as much savings in its final pot compared to just purely investing it, there's 8 years of no mortgage payments. That's reduced stress, reduced overhead, reduced bills for situations like family emergencies, anything like that. The boiler breaking down, your car going off a cliff. Having that flexibility does have a real value to it. And that's the thing, it's really easy for finance bros and finance influencers to get bogged down on the spreadsheets and think, this number bigger than that number, so must be better. The reality is, there's a real value on things like flexibility and reduced stress, even if that value isn't necessarily able to be put into a monetary value. So yes, with the Seesaw Method or paying off the mortgage early, you might have less in your savings pot. But if you put a value on your peace of mind or your flexibility, then the real value of it might end up being the complete opposite way about. So again, it's just up to each person individually what method might be right for them. This video just highlights the differences between them all and what you might want to consider. Now, with that said, there is also some likely clear-cut examples of when paying down stuff like loans is going to be probably just strictly better than investing, outside of minimizing your anxiety around it. Such as stuff like super high interest debt. Stuff like credit cards might have 25-30%. Then paying down that debt is likely just going to be way better when it compares to investing. Other times that it's likely going to be more weighted towards paying down debt is stuff like coming up to retirement. If you're 5 years, 10 years out from retirement and you still have a long outstanding mortgage or car loan, paying that down more aggressively so that you have less debt by the time of your retirement likely has a higher value compared to investing it. Not to mention that if you're older, there's a shorter time, there's a shorter investment horizon for your money to really compound. And then another one to bear in mind, which people might not take into consideration, is that if your income is unstable, whether you're a gig worker or a business owner that might be very seasonal, if your income's really unstable, paying down debt so that it's not there when your months are bad is an important thing that should likely be tackled more than investing. And then on the flip side, there's probably scenarios where more times than not, you're going to be always better investing. And these ones are conversely a really low interest rate loan. So something like 2% or 1.5%. If these are the percentages on your loan, then you're likely always going to be better investing it into something like a globally diversified index fund. And then another consideration might be if you've not fully utilized stuff like your ISA contributions, trying to get the most out of them while you can is an important thing to bear in mind. Although I wouldn't say that overrides paying down super high interest debt right enough. But yeah, with that, I hope you have really realized that sometimes when it comes to your finances, spreadsheets aren't the final arbiter of what is the right thing to do. Two people could have the same income, the same mortgage rate, and the same expected returns. And both of them could have a completely different approach to how they want to tackle this issue. One of them might feel completely trapped about having debt, and the other one might feel completely trapped not seeing that they have any savings built up. And the thing is, neither of them are right and neither of them are wrong. The fact of the matter is, again, the key word in personal finance is personal. So with this video and any other video on these types of topics, don't take it as gospel. Bear in mind your own unique situation and do the research, see other scenarios, other points of view with these types of things before you make any decisions, or even consider speaking to a professional like a financial advisor, and they'll be able to really tailor their advice for you and for your situation. But yeah, with that, thanks for watching. If you don't mind now, I've got an extra £500 a month that I need to put into my Uber Eats account so that I can make sure I try all the restaurants in Glasgow. But with that, if you're ever curious about your interest savings and whether you can save tax on those payments and make it so that you're not needing to, because I can guarantee it, most people shouldn't be paying any tax on their interest. If that sounds like you, be sure to check out this video that I've made here covering that topic. And if not, until next time.